Where were options traders pumping up the volume this week? General Motors. Call activity on the name was 4 times its normal volume.
Welcome back to Options Action. Time to make the call, where we tell you how the smart money is trading ahead of next week's action. And few stocks have seen more bets turn bad than gaming stocks, but do options traders sense an ace in the hole?
Talk about a bet gone bust. Casino stocks, once thought recession-proof, have crapped out this year over concerns of a tumbling economy and balance sheets on tilt.
People really have no confidence that funding is available and assets are saleable.
Take Las Vegas Sands and MGM. Their stocks have been crushed under a mountain of debt as they expand their global empires. So like a gambler down to his last chips, casino companies are looking to go all in, trying to raise cash in the hopes of hitting a jackpot. Some like the odds.
If LVS could sell something in Macau for the tune of $1 billion or more, I think the stock could as much as triple.
With payouts like that, it's no wonder options traders are looking to up the ante. So how is the smart money playing this hand?
And to answer that question, Jared Levy, Chief Derivatives Specialist at Financial Markets Education Division of Peak 6, joins us here on set. Jared, great to have you with us.
Thanks for having me.
And you say forget about LVS, forget about MGM, you like Wynn. Why does Wynn stand out?
Well, first of all, let me just say this. Wynn stands out because it's the best in breed. It's a stock here in the sector, $3.1 billion market cap, much better than the others. It's sitting up around $28, $30 into the close today. Listen, this stock has earnings next week, so there's certainly a wild card here. The reason why I'm looking at Wynn and the trade that I'm looking at is actually a bull put spread. Just going in and buying the stock, I think, is risky. And if we compare the two, the bull put spread has much less risk. And here's what I'm looking at. Selling the 25 puts in February and buying the 2250s underneath of it. I'm doing that for a credit of 40 cents, okay? And that leaves me with risk of $2.10. No matter how low this stock goes, the most I can lose in this trade is $2.10, which isn't bad considering it's a $28 stock that could potentially be all over the place.
All right, let's walk through the options advantage here, because the maximum gain is $40 basically.
40 bucks.
Your maximum loss is 210. It seems like not that much upside here.
You know, I just have to jump in here with this trade for just one quick second, because, you know, one of the things I would say is that if I was going to sell puts in one of these names, I'd want to buy some other puts to protect myself,
right,
because these things are moving all over the place. As you point out, earnings coming up. You know, we don't really know what's going to be said. There have been some comments made about revenues in Macau, for example, falling significantly in these types of things. But my question is, if you're bullish on a stock, why do you want to sit there and just say, okay, I'm going to try, hopefully, to collect 40 cents, rather than trying to make something that might have a little bit more, you know, a little bit more upside on something that is moving around so much?
It's a good question. I'm a probability guy. You know, the way that I place my trades is this. I try to stack all the odds in my favor, take little bits and pieces out of the marketplace. This stock can go up, it can go sideways, it can actually go all the way down, in this case, to $24.60, and I still walk away with 19% return on my money. When I buy the stock outright, I've got 100% risk. And frankly, I don't know where the stock's going to be in 2 weeks. It's so difficult to make an exact prediction. And in my mind, to stack the odds in my favor, be able to collect 19% on a $210 investment per spread.
Okay, I want to bring in our friend in Philadelphia. Stacy out there, what do you make of this trade, especially given Jared brings up a good point, earnings next week? That could be a real wild card.
Right, but well, given the earnings, you most certainly don't want to sell these puts outright unless you really have a floor where you want to buy that stock, going back to some of our previous strategies. But a couple of points I want to say about Jared's strategy. First, let's think about what you're really doing here. I know Mike is not a big fan of selling some of these smaller spreads and collecting something as small as 40 cents. But let's think about what this 40 cents really is. As Jared said, you're collecting 40 cents to possibly lose $2.10. 40 to 210, you have your odds right there. So in other words, you're basically saying you think the probability of the stock to go below 22.5 is less than 16%. If you're comfortable with that, take your 40 cents. If you think that's way too low, take the opposite side of Jared. And actually, I would agree with Mike on one point here. If you actually are bullish on Wynn, I think there are better strategies than selling this put spread. But this is one where you have a level where you're somewhat comfortable saying the stock doesn't go below. You're really saying that floor, but you're buying that extra put for protection.
We gotta go. Jared Levy, thanks so much, and thanks so much for your trade tonight. Got a question? Send us an email, optionsaction@cnbc.com. We would love to hear from you. Stick around. Your final call is up next.
Options Action is sponsored by Think or Swim.